The U.S. Justice Department has initiated an investigation into Federal Reserve Governor Lisa Cook over allegations of mortgage fraud. The inquiry was prompted by a referral from Bill Pulte, director of the Federal Housing Finance Agency, who claims Cook improperly designated two properties as primary residences to secure favorable mortgage terms. This investigation coincides with a contentious legal battle regarding her potential removal by the Trump administration. Cook argues that the effort to dismiss her is politically motivated, aiming to undermine the Federal Reserve's independence, which is traditionally insulated from political influence to ensure unbiased economic policymaking. The Justice Department, however, has dismissed Cook's claims that former President Trump seeks her ouster to control the Federal Reserve as baseless, asserting that the president has the authority to remove Fed governors for cause. This situation highlights the broader tension between the Federal Reserve's operational independence and potential political influence. Economists express concern that political pressure could compromise the Fed's ability to make necessary economic decisions, such as adjusting interest rates to manage inflation, which are crucial for maintaining market stability and investor confidence. The outcome of this legal and political struggle could set a precedent for the Federal Reserve's governance and its future policy-making independence.
Stephen Miran, President Donald Trump's nominee for a Federal Reserve Board vacancy, has sparked controversy by announcing his intention to retain his position within the White House if confirmed. Miran, currently serving on Trump's Council of Economic Advisers, assured lawmakers during his confirmation hearing that he would act independently and take a leave of absence from his White House role due to the short-term nature of the Fed position. However, Democrats expressed concern that his dual roles could undermine the Federal Reserve's independence, fearing that it could bring the president closer to influencing central bank decisions. Senator Elizabeth Warren criticized Miran's potential appointment as a threat to the Fed's autonomy, suggesting that it could erode trust in the institution's ability to set policy free from political pressure. This development comes amid ongoing tensions between the Trump administration and the Federal Reserve, with Trump previously applying pressure on the Fed to lower interest rates and contemplating actions against key figures like Chair Jerome Powell and board member Lisa Cook. Economists warn that such political interference risks damaging the credibility of the Federal Reserve, which is tasked with maintaining economic stability through independent policy decisions. While Republicans generally support Miran's nomination, Democrats argue that his continued White House affiliation signals a potential susceptibility to presidential influence. Miran's nomination is poised to proceed to a full Senate vote, where the Republican majority is likely to ensure his confirmation. The situation underscores broader concerns about the potential politicization of the Federal Reserve and its implications for economic governance.
The U.S. House of Representatives has narrowly passed the third of 12 necessary appropriations bills, allocating $57.3 billion for energy and water infrastructure. With a vote of 214 to 213, this passage marks a small step in the government funding process for fiscal year 2026, amidst looming concerns of a potential government shutdown. The bill emphasizes traditional energy sources, allocating over $25 billion for nuclear energy and weapons development, $9.9 billion for the Army Corps of Engineers, and $8.4 billion for the Office of Science. It also invests in mining technology for critical mineral extraction and directs $687 million toward fossil fuel development. However, it cuts funding for renewable energy initiatives and eliminates funding for the Office of Clean Energy Demonstrations and several diversity, equity, and inclusion (DEI) programs, leading to unanimous opposition from House Democrats and 4 Republicans. The bill's passage underscores significant partisan divides, particularly concerning energy policy, with Democrats criticizing the reduced emphasis on renewable energy and environmental initiatives. The Senate, controlled by Democrats, is expected to challenge the bill, complicating its path to final approval, as at least 7 non-Republican votes are needed, with the September 30th deadline approaching, marking the end of fiscal year 2025. There is increasing pressure to pass all 12 appropriations bills to avoid a government shutdown. Given the slow legislative progress and ongoing partisan disagreements, a continuing resolution may be necessary to temporarily maintain government funding at current levels while negotiations continue. This situation reflects broader challenges in achieving bipartisan consensus on fiscal priorities and the potential economic implications of delayed government funding.
Ørsted, the Danish developer of the Revolution Wind offshore wind farm, has filed a lawsuit against the Trump administration following a stop work order that has stalled the project's progress. The Bureau of Ocean Energy Management, BOEM, part of the Department of the Interior, issued the halt, citing national security concerns, including potential drone swarm attacks and radar interference. The 704-megawatt project, which is 80% complete, is designed to supply energy to Connecticut and Rhode Island by next year. Ørsted argues that the order lacks statutory authority and seeks a preliminary injunction to resume work. This legal action underscores the challenges faced by renewable energy projects under the current U.S. administration, which has expressed skepticism toward wind energy. The stop work order has also prompted Fitch Ratings to downgrade Ørsted's stock outlook from stable to negative, reflecting concerns over the operating environment in the U.S. and potential implications for Ørsted's financial health. The uncertainty extends to Ørsted's Sunrise Wind project, which is 35% complete and is expected to deliver energy to Long Island by 2027. Ørsted plans to raise over $9 billion through a stock offering, with $6.2 billion allocated to complete Sunrise Wind. The developments highlight the precarious position of offshore wind projects amid shifting regulatory landscapes, potentially affecting market sentiment and the strategic direction of companies involved in green energy initiatives.
Coca-Cola's $5 billion acquisition of Costa Coffee in 2019, aimed at expanding its footprint in the global hot beverage market, is facing challenges, prompting the company to consider a potential sale. This strategic move was initially part of Coca-Cola's ambition to transform into a total beverage company, leveraging Costa Coffee's established presence in 50 countries and its comprehensive coffee supply chain. However, the acquisition's anticipated growth has been hindered by unforeseen circumstances, including the COVID-19 pandemic, which significantly impacted Costa Coffee's retail operations due to prolonged lockdowns, particularly in the UK. The pandemic delayed Coca-Cola's plans to expand Costa's reach through vending machines, at-home products, and partnerships with restaurant chains. Despite efforts to penetrate the U.S. market and diversify Costa's offerings, Coca-Cola has struggled to gain significant traction against entrenched competitors like Starbucks. The pandemic not only stalled strategic advancements, but also exposed Costa Coffee to financial pressures, including soaring coffee prices and shifting consumer preferences exacerbated by inflation. As a result, Coca-Cola is now working with investment bank Lazard to explore options for Costa Coffee, including a potential sale, as the brand's performance has not aligned with Coca-Cola's initial investment hypothesis. This development underscores the challenges multinational corporations face in adapting to rapidly changing market conditions and consumer behaviors, particularly in the highly competitive and evolving coffee industry.
GE Aerospace, NYSE, GE, is facing significant labor challenges as over 600 United Auto Workers, UAW, members have initiated a strike at two key facilities. The strike, which began on August 28, affects the Evandale, Ohio plant responsible for manufacturing industrial and marine engines for the Navy, and the Erlanger, Kentucky distribution center that supplies parts to engine plants. This labor action is part of a broader trend of unrest in the aerospace sector, with workers demanding improved wages and job security. Despite the strike, GE Aerospace's stock has performed strongly, with a 63% increase year-to-date, underscoring its position as a leading defense stock. The strike's impact on GE Aerospace could be significant, potentially disrupting production and supply chains, which may affect the company's financial performance in the short term. The company has implemented a contingency plan to mitigate these effects, but expressed disappointment over the union's decision to strike before voting on a new contract offer. This labor dispute highlights the ongoing tension between employers and workers in the aerospace industry, reflecting broader economic pressures and the growing demand for better labor conditions. Investors and analysts will be closely monitoring the situation, as prolonged disruptions could influence market sentiment and GE's stock performance.
MongoDB, Inc., NASDAQ, MDB, has demonstrated robust financial performance in its second quarter of FY25, reporting a 24% year-over-year increase in revenue to $591 million, surpassing its guidance. The company achieved a non-GAAP EPS of $1, exceeding estimates by 54%, and expanded its operating margin to 14.7%. A key driver of this growth is MongoDB Atlas, the firm's cloud database service, which generated $438 million in revenue, marking a 27% increase and constituting 74% of the total revenue. The company's net new annual recurring revenue, surged by 76% to $169 million, highlighting strong enterprise adoption and customer growth, with significant wins including Deutsche Telekom and Bank. MongoDB's strategic focus on AI and product innovation is evident with the release of MongoDB 8.0 and the integration of AI-native capabilities like vector search. The recent acquisition of Voyage AI further positions MongoDB at the forefront of the enterprise data and AI intersection, embedding AI models directly into its platform. Despite challenges such as a decline in non-Atlas subscription revenue and high stock-based compensation, the growth in Atlas is offsetting these headwinds. Management's optimistic outlook is reflected in the raised FY26 revenue guidance to $2.34–$2.36 billion, emphasizing sustained growth potential. The stock has appreciated by approximately 51% since March 2025, driven by the momentum of Atlas and the expanding AI opportunities. While MongoDB is not among the most popular stocks among hedge funds, its strategic positioning and growth trajectory make it a noteworthy contender in the tech space.
Bangladesh has emerged as the country with the highest non-performing loan (NPL) ratio in Asia, with defaults reaching 20.2% of total loans in 2024, according to a recent Asian Development Bank (ADB) report. The report highlights a significant 28% increase in distressed assets year-over-year, bringing the total to $20.27 billion. This marks Bangladesh as having the region's most fragile banking system, with the NPL ratio soaring by 11.2 percentage points in just 1 year. In contrast, other South Asian countries like India, Pakistan, and Sri Lanka have managed to reduce their NPL ratios, with India notably cutting its ratio to 2.5% through comprehensive banking reforms. The surge in Bangladesh's NPLs is attributed to long-standing regulatory laxity, political interference, and legacy issues from previous administrations. The Bangladesh Bank has started to disclose the true extent of bad loans, which economists warn could lead to further increases in reported NPLs as loan classification rules tighten. Experts suggest that Bangladesh could learn from India's experience, where strict enforcement of banking reforms helped control defaults. The ADB emphasizes the need for robust regulatory frameworks and proactive policy measures to manage NPLs across Asia, especially in light of potential global economic slowdowns that could exacerbate the situation. The report advocates for enhanced judicial efficiency and market transparency to develop a more integrated secondary NPL market in the region.
Sherwin-Williams has announced the suspension of its 401k matching contributions effective October 1st. Citing weak sales driven by economic challenges such as high mortgage rates, inflation, and tariff-induced cost pressures. CEO Heidi G. Petz highlighted that these factors have significantly dampened both housing demand and DIY activities, leading the company to adopt aggressive cost-saving measures including reduced third-party spend, operational simplification, and delays in new hires. This move mirrors similar actions taken during past economic downturns, such as the 2009 financial crisis and the 2020 COVID pandemic, with the company expressing intentions to restore full matching when conditions improve. Though no timeline has been provided, the decision comes as Sherwin-Williams navigates a broader economic slowdown characterized by declining job openings and tempered hiring across the U.S. labor market. Despite these challenges, the company remains committed to long-term growth strategies, including expanding its store network and sales force. Sherwin-Williams's stock price, trading at approximately $365, reflects a slight decline from its late August peak, but shows an 18% increase from its spring low, indicating investor resilience amidst market volatility. The company anticipates these economic headwinds to persist through at least the first half of 2026, underscoring its strategic focus on maintaining financial stability while positioning for future growth.
MicroStrategy, MSTR, has increasingly become viewed as a leveraged proxy for Bitcoin rather than a traditional enterprise software company, with its core software business experiencing stagnant or declining revenues. The company's strategy involves issuing debt and selling new shares to acquire more Bitcoin, a move that has shifted its valuation narrative entirely towards cryptocurrency. This approach, dubbed a perpetual dilution machine, allows existing investors to see an increase in Bitcoin per share as long as new buyers continue to pay a premium. However, this setup exposes shareholders to potential overvaluation risks, as they effectively pay significant premiums compared to direct Bitcoin ownership. This premium sustainability is questioned, especially with the availability of cheaper and more direct investment vehicles like spot or leveraged Bitcoin ETFs. The reliance on Executive Chairman Michael Saylor's charismatic promotion of the number go up thesis further adds to the precariousness of MSTR's market position. Critics argue that the company's valuation is more narrative-driven than based on strong fundamentals, echoing its past vulnerabilities, such as during the dot-com bust. The recent analysis highlights the risks associated with MSTR's high leverage, deteriorating software operations, and fragile balance sheet, which have contributed to approximately 10% stock depreciation since earlier bearish assessments. Hedge fund interest in MSTR has also waned, with 33 funds holding positions at the end of the first quarter, down from 44 in the previous quarter, reflecting cautious sentiment amid the company's speculative positioning in the market.